Hey guys, hope you are having a great day so far. Quickly before we start, I wanted to recap today was a fairly slow day as anticipation for CPI data tomorrow had the markets trading a bit weird. Still, we had 3 solid alerts, though I did mention to enter cautiously in 2 of them. There were a couple penny stocks I would have liked to alert but missed on that opportunity. Come see for yourself what you are missing out by joining the Discord and getting day trade alerts and much more. So, an interesting set of news came out that went out quieter than a dead mouse. You see, for months, we have been spoon-fed a whole lot of dog shit. As you know, we have been led to believe that inflation is being consistently brought down. For the month of December, it was announced that the Consumer Price Index came out at a decline of 0.1%. Well, it would appear that was conveniently wrong, and just at the end of last week, was corroborated to have been revised, with the real CPI number showing prices actually increased, not decreased. I find it incredibly incompetent and absurd that CPI numbers can be released and not be fully accurate. See, this decrease in perceived inflation was a large part of why markets pumped up, and now that we see these numbers were all but made up, it kinda puts into perspective why Jerome the Joke Powell was so hawkish in his speech last week. Ignoring and putting aside for a moment the fact that markets rallied to the moon just on his appearance alone, I found his hawkish demeanor quite weird given the last minutes released, where the Fed appeared to become the most dovish we have seen in a year. I had some of my viewers ask why are prices so high and remaining as high even if inflation is going down and supply chain issues are being resolved. Well, you see, during the pandemic, the market and Wall Street realized that people were willing to buy overpriced necessities. It doesn't matter if prices double or even tripled, companies in Wall Street learned that consumers were willing to spend so much more, and as a result, they are unwilling to lowering prices. The only way a place like a grocery store would be willing to lower the price of goods would be if demand suddenly dipped, something that could be seen during market crash. When the economy is inflated, the only way profits are going down is when people stop buying at elevated prices, because corporations will not willingly drop prices back to a perceived normal when they know people would willingly spend more, even if it encroaches the economy into a recession, which is a challenge that Jerome Powell is trying to remedy. So, given that the revision we had resulted in December CPI actually climbing, what does that spell out for the market overall in the coming month? Tomorrow we will receive new CPI data, and I strongly believe that this CPI report could have enormous implications going forward. A higher than expected CPI report would now mean 2 consecutive months where inflation ran hotter than expected, meaning the government's and Fed's ability to control it will once again become questioned. The markets have been rising since the start of 2023, and a bad report will shatter even the most bullish of investors' hope that recovery will be steady. This can cause significant reversals. Analysts right now are predicting the headline CPI will increase by 0.5% month over month. Core CPI is expected to rise by 0.4% month over month. This report will be particularly tricky to interpret because of recent gains and some inflationary factors. Trends in the inflation swap markets have been on the rise. If you price in the 1-month zero-coupon inflation swap market on Friday, it continued to show rising inflation expectations for January. All in all, despite the expected increase in inflation from analysts and the warning from the inflation swaps, options and bond market about a potential trend of higher than previously expected inflation, the equity market remains out of touch. Many parts the market expect a hotter than expected CPI, so if it does come in hotter, the equity market might find itself on the wrong side of the trend and we could see a big sell-off. To me, the problem with Jerome and the Fed as well as the government comes in the lack of direct disclosure as to the progress of inflation. Yeah, I might be willing to forgive a revised CPI report, but how can you then pretend to be so bullish one week and then severely hawkish the next? The Fed knows exactly what is going on. They understand that inflation is sticky and permanent, and I think they believe the job market to be a much more fundamental and integral part of the problem than has been led known. This type of tipping back and forth is leading to a large amount of volatility in the markets, and I have to wonder if it is actually being done in purpose. If you were to ask me what I think the Fed's perspective on matters is right now, I wouldn't be able to tell you with 100% certainty that the Fed is hawkish or dovish. Looking at the data, I would say the Fed would need to be hawkish right now, but then they come out with these weird half-assed statements that make no sense, contradict previous stances on the problems and throw everyone off the loop. The Fed's lack of transparency with the public is a thing of huge concern that should be addressed. We are getting revised CPI data that showed worsening conditions on December, the market's now expecting an even worse reading for the month of January, which will be shown tomorrow, and yet as of me making this video, markets are being pumped. This type of artificial manipulation of valuation on the equity markets is beyond reprehensible. When you add in job market data along with unemployment, and you sprinkle in the fact that the biggest corporations in the world announced poor revenue and lower guidance, it makes you wonder who exactly is buying at these levels. I understand bullish behavior, but according to some statistics, it appears people are not buying aggressively at the moment, leading me to believe this fake pump is being carried out by big money. In fact, let's go over some data real quick. The January 20, 23 non-farms payroll report was a scorcher with 517,000 jobs added, which was far higher than the consensus estimate of 187,000. Wages also increased at 0.3% month-over-month and 4.4% year-over-year, coming above expectations as well. The Fed increased the Fed funds rate by 25 basis points to 4.5%, and in spite of the 11% rise in the S&P 500, Powell has not at any point talked down the market. He actually seems to be pandering to bulls, even when what he says is hawkish, which sort of follows the train of thought that he is not being very transparent and honest. Following the excellent job numbers, the bond yields began to rise, signaling that the battle against inflation is far from over. 10-year treasuries jumped up, erasing all of January's gains. The biggest sign of over-optimism comes from the re-rating of the Nasdaq 100. Today's PE of 24 shows we are still way ahead, way over our heads by 33%. Guys, out of the big 5 companies, only Microsoft had a positive increase in earnings with a softer 1% guidance. The markets gave the nod of approval to these companies because we want to believe, against all evidence, that things will go back to how they were in 2020. This is a big mistake, because given all the evidence at our disposal, there is significant reason to believe that megacaps are going to drop in the coming future. So naturally, the next question that should come to the mind of investors is, if this rally is unsustainable, when do the lights go out? Well, though I strongly believe that part of the reason stocks went up is attributed to dumb retail investors and big money manipulation, I would also introduce a third alternative. A large part of the run-up was in part caused by short covering and low positioning. Looking at the VIX, its lead rally had appeared to run its course, and it is very likely to be unable to continue. J.P. Morgan chief strategist Marko Kolanovic wrote that fund managers are still not fully invested, meaning that they are not eating into the news that we have reached the bottom yet. Me personally, as I said, I am waiting for summer. I think by then, if there is a chance that the system is going to break hard and fail, it will happen around that time frame, not so early as of spring in 2023. If you are looking at opening long-term positions, I would be looking to add in small chunks rather than all at once. Remember, recovery for inflation will not be a clear upwards movement, it's going to be jaded and look like a heartbeat monitor. Now, remember that when I talk about these things, I am not talking about tomorrow or even the weekly. Looking through technicals, it appears that there are plenty of bullish signals up that could enhance plenty more bullish runs in the short term, so don't take this video as confirmation for any bearish bet. Use it to have more information by which to use to make any decision you make. As we know, technical charts have much more influence on prices than that of fundamentals. The situation is incredibly frustrating for everyone right now, so keep calm and don't rush in to buy out of fear of missing out. Lastly, I do want to bring up the obvious for everyone to take into consideration. We don't know what is going on lately with all these flying objects being shot down, but it appears that the Pentagon is clearly concerned and on high alert with all these events happening. These types of occurrences, if they continue happening, will have severe effects on the already poor relationship between the US and China. Now, again, this is assuming we aren't shooting down ET, but China's consistent pervasive behavior will not be tolerated indefinitely, and this might be a trick on their sleeve to have something happen of major escalation so that they can cry wolf and be given the moral authority to do something more drastic. Again, I don't have insider information to anything, but these things are serious, much more than the public might realize. I am not saying beware of another conflict. I am just saying from a purely mathematical standpoint, we are much closer to it now than we were a month ago, and this will weigh on stocks. As I was about to close out the video, news came out that the Federal Reserve is likely to have to keep raising interest rates to rein in price growth, which could slow economic expansion and affect the jobs market, according to Governor Michelle Bowman. At the Community Banking Conference today, Bowman said, and I quote, "We are still far from achieving price stability, and I expect that it will be necessary to further tighten monetary policy to bring inflation down toward our goal. Doing so will likely lead to subdued growth in the economic activity and some softening in labor market conditions. Bowman talked about how restoring price stability is essential to support a sustainably strong labor market, stating that while there are costs and risks to tightening monetary policy to lower inflation, she sees the costs and risks of allowing inflation to persist as being much greater. Keep in mind, Fed officials lifted their benchmark interest rate by a quarter percentage point to a range of 4.5% to 5.75% on February 1st. Officials in December forecast rates peaking at 5.1% this year, according to their media projection. They will be updating these estimated next month, which will be pivotal for everyone to pay attention. The ongoing tightness in the labor market puts upward pressure on inflation, even if some components of inflation moderate due to improvements in the supply side factors. Bowman said the longer high inflation persists, the more likely it is that households and businesses may come to expect higher inflation in the longer term. Should that be the case, the Fed's job of lowering inflation would be even more challenging than it already is. As you guys can see, Bowman holds the same opinion I do. The longer inflation persists, the harder it will be to get rid of. It makes people anticipated longer inflation while simultaneously eating into the remaining buying power they have. Americans already exhausted their savings. What will happen when they max out their entire credit lines? That is something we will find out this summer, because unless these economic conditions are fixed, we are set on a timeline of make or break. Guys, I cannot tell you enough to come join our Discord. We have been killing it today as well for the most of last week. The only day that was wacky was Friday, but the rest of the week was absolutely phenomenal. Come see for yourself our trades and take part in joining the rest of our community. The link will be in the comments below. I will see you on a later video this week. Until then, have a great rest of your day and to the moon.